Hi everyone, thank you for tuning into my channel. The content I create is broken out into interior designer, business management and accounting, studio designer tutorials and webinar, and basic financial literacy. I try my best to organize the videos by playlist, so be sure to check out the full playlist and the recommended videos at the end of each series. Be sure to hit the thumbs up button below and subscribe to stay updated. And feel free to comment any questions you may have or any topics that you would like to see covered. That being said, I'm going to just dive right in. This is going to cover partnerships and equity, okay? Due to the time of year, it is, with tax and everything, I am getting a lot of emails and just inquiries on this very topic. So I zeroed out the financials that you're looking at. Okay, this is my training account, so I have zeroed everything out to kind of go over and cover this topic. Okay, so in this case that we're going to cover, I am going to do a posting that of what it would look like should there be two partners in this partnership. Okay, this is why it's so important to make sure that there is a partnership agreement in place, and that profitability and expense allocation and how you may treat non-capital types of contribution, okay, and things like that. If you have no idea what I'm talking about, please definitely book a call with me, and I'm happy to kind of go into that in detail. But that being said, we are going to go over a scenario where there are two partners, okay? And like I said, in a situation where there is an even amount for partners, or in a case where there's only two partners, I always recommend not going 50-50. Somebody needs to have 51-49 in the event that, you can't come to an agreement, okay? And we're deadlocked, okay? So as you can see, there is nothing here, and typically what happens in a new business, we're going to open the bank account, and I did go ahead and prep my journal entry, okay? And what it looks like here is that we're getting $5,000 from each partner to go ahead and open our new business checking account, okay? I did date it for the first, and I'm going to go ahead and post that, okay? There are other ways to get these totals in if I was really doing the books, but I'm not, so I'm just gonna go ahead and show you what this looks like. So now that I've posted this, I should be able to pull up my new financial statement that shows what just happened, okay? And I wanna show you what that looks like. So this is the part that kind of gets a lot of confusion in the beginning. So this is what it looks like when we both contribute the same amount of money and open this checking account. Now, over the normal course of business, things happen, and there are cases where maybe you've charged things that may have been on a personal. There's a number of different things that could happen in a year, right? That could change what the owner's equity looks like. But what I want to kind of explain and go over in this video is, first, the fact that this is what it looks like when you first put that money in, okay? And I'm gonna go ahead and fast forward now, and I'm gonna, okay, and for educational purposes, I am fast forwarding to December 2023. You can see now, you still see that the original contributions by the partners when we first opened the bank account, and after the rest of the year had transpired, we have a profitability for the business for $113,191.50. Okay, so now comes into the K1s. Okay, when you submit these financials to your CPA to prepare them for tax, in the case when you own a business, it's a little different than when you were an employee and maybe had a W-2 that you used to file your taxes. Now, in terms of a partnership, you get a K1, okay? And how it's different from a sole prop or a Schedule C on your personal tax return is the fact that there is another person involved. So when you have a partnership and a partnership agreement, we now have to allocate the profitability, which in this case it's this, okay? We want to allocate the profitability amongst the partners accordingly. And remember how I said that in the case where they contributed the same cash amount, and now the partnership agreement reads, remember I said that we would do 51%, 49. So how this splits out, okay, it's not really going to be split evenly, right? That it's going to be that one partner is going to claim 57,727 and 67 cents of that income, and the other partner is going to claim 55,463 and 84 cents of that income. Okay, that's all that a K1 determines, and that was fairly simple in the case that we're talking about, because there are only two partners. And I went ahead and posted the journal entry that allocates that amount. So now when you're looking at this, you can see that one partner, and basically you're going to take the net or the total of these two. So it'd be that 57, 727, 67 plus the 5,000. So partner one's equity is $62,727.67, and partner two is at let's see, it's at, I know that I should show this calculation to you, but I am just adding the totals. So that is $60,463.84 of equity. Okay, and I'll just show you. I'm basically just doing it on a spreadsheet, right? So that is the total equity, and when you add that up, it basically is that it brings it back and realigns it to that 51.49%. Okay, and if there are any questions in regards to that, you will have to book a call, but that is the basic, overall theory and processes for how that works. Okay, so I want to make sure that I covered this, because I feel like there's so many gray areas. And what really does your equity mean? Well, when I look at this in terms of the business as a whole, I'm looking at the cash. So that's obviously here, the 142, 147 and 51 cents. So if I basically went to the bank, liquidated this, or made it all cash and brought it back to the office, and I contacted anybody that owed us money, I sold whatever it is that's an inventory. I went ahead and took care of this, right? So basically we're collecting and cashing out everything that's up here. We're going to pay off anybody that we owe or any liabilities that we have. And as you can see, we don't have a credit card on this business. So if we were to take all of this and liquidate it, we would have $150,029.36. What we owe is $26,837 and 86 cents, which would then leave the 123, 190, 150, and how we would split that after that would be the 51.49, which is this. Okay, so if you add these two together, and we're a penny off, so let's make this 66. Okay, oops, I'm a penny off. So if we were to add these together, you can see that it clearly ties out to the totals here. Okay, so it 123, 190, 150, and it would be split out like this. Okay, hopefully that makes sense to you. This was a very basic case. I wanted to do additional situations where we'll see different circumstances and a little bit more complex issues, but those will be available on my website, and they are available for purchase, or if you have a subscription, you can just download them. Okay, thank you so much.